Welcome to the deep dive. Today, we are taking a deep breath and plunging into one of the most intellectually rewarding, yet maybe emotionally frustrating stories in European public markets. Basic Fit, that's ticker symbol BFAET.
It really is the ultimate puzzle, isn't it? We're
Yeah.
looking at the largest European gym chain. I mean, think Planet Fitness in the U.S., but for Europe. They absolutely dominate that low-cost fitness tier across, key markets like France, Spain, the Benelux countries.
Yeah, and by every fundamental metric you look at, scale, proven unit economics, the potential for growth across Europe, this business should have been a stellar performer for years, a real growth compounder.
Absolutely. But then you look at the stock chart.
Oh, the chart. Yeah, the story is just, well, flat, maybe worse than flat, bordering on depressing, really, over the last 4 years. The price has been stuck, just anchored stubbornly around that, 23 to 25 range?
Exactly. It's that classic market paradox, right? You've got a
Yeah.
business model that seems structurally brilliant, but a stock that's delivered, well, practically nothing for ages.
And that flat performance, it's obviously led to a lot of, let's say, deep cynicism among the long-term investors. I mean, our sources are pretty blunt about it. They acknowledge the frustration.
They have to be.
Yeah.
So the core issue we really need to unpack today is kind of twofold. First, why did the consensus and, arguably management too, why did they miss the mark so badly in the last few years?
Right. What went wrong?
And second, why structurally might this be one of the clearest, maybe hidden alpha opportunities available right now, despite all that historical pain?
Okay, so that's our mission then. Let's try and move beyond that frustration. We'll dig into the source material, see if we can reveal why those consensus expectations for BFIT lagged so much. It seems like it was mainly down to operational missteps and some pretty complex accounting, right?
Yeah, that's a big part of it. And crucially, we want to demonstrate why the underlying business might now be dramatically undervalued compared to its actual cash flow generation and maybe its de-risked growth potential going forward.
We're hunting for those twin engines, as analysts like to call them.
That's the goal. You need both for superior stock performance, solid cash flow growth, and multiple expansion. Getting the market to pay more for each dollar of cash flow.
Okay.
And the details analysis we've looked at, it really argues that for the first time since, well, the pandemic chaos, both of those engines are actually starting to fire.
So if the market starts to apply a higher multiple to that accelerating cash flow.
The re-rating potential could be immense, huge.
All right, let's get into the engine room then. Start with the basics, the core business model. Basic Fit is, as you said, a laser-focused, low-cost operator. They're not trying to be a fancy spa or anything.
No, not at all. It's pure affordability, volume, and just relentless efficiency. That's the game plan.
And the strength of that model, being the low-cost leader, it's key, isn't it?
Oh, it's absolutely crucial. Being dominant in the low-cost segment, it tends to create the most durable competitive advantages you can get in consumer businesses. We see it over and over again, right?
Like Walmart.
Exactly. Walmart in retail, Costco in wholesale, even Amazon's original e-commerce model. Once you build the most efficient operation at the lowest price point, it becomes incredibly tough for anyone else, new entrants or legacy players, to really compete effectively.
And their idea of basic isn't like a rundown old gym anymore.
Not at all. That's changed completely. Basic Fit gyms have modern, pretty high-quality equipment. They've got digital classes through an app, 247 access in most places.
All at a price that just kills the traditional mid-tier gyms.
Precisely. It just undercuts them dramatically. And that's the strategic genius, really. They're squeezing that middle market, the local gym that used to charge maybe 50, 60, 70 euro a month for slightly nicer changing rooms, but maybe less consistent equipment or fewer locations.
Those places are caught, aren't they?
Completely caught in the middle. They can't match Basic Fit on price or convenience, and they certainly can't match the premium clubs on like specialized experiences or fancy amenities, so they're just structurally using market share.
How does Basic Fit actually achieve that cost advantage? Is it just scale?
Scale is huge, but it's also the operating model. They use a really lean, skeletal staff model, highly centralized operations. They leverage technology heavily for check-ins, customer support. The app does a lot of the work.
So fewer staff needed on site.
Way fewer. Often they can run a gym with just 3 full-time employees. Compare that to maybe 6 or even 8 for a smaller independent competitor trying to offer similar opening hours. That's a massive cost saving right there.
Okay, let's talk about the other big strategic piece, the cluster strategy. Some people call it fortressing. We saw those maps for Amsterdam and Paris. They really pack them in, don't they? Opening gyms almost next door to each other sometimes.
Yeah, it looks counterintuitive, like they'd cannibalize themselves, but the logic is more like hyper-efficient distribution. Think Domino's Pizza in a really dense city.
Okay. How so?
The goal isn't necessarily to capture 100% of every single gym goer. The goal is pure convenience and accessibility. Basic Fit wants to make sure that wherever you are, home, work, running errands, you are always like within a 10-minute walk or maybe a short drive of one of their gyms.
That makes the service sticky, right? If it's
Mm.
right there, you're more likely to use it. A 20-minute drive, maybe not.
Exactly. That removes a major friction point. And think about the value for the member. One low-cost membership gets you access to that entire cluster of gyms.
Oh, so if I work downtown and live in the suburbs, I can use the gym near my office and the one near my home.
Precisely. No single mom-and-pop gym can possibly offer that kind of multi-location value. Plus, once they saturate a city like Paris with, say, 150 locations, their regional marketing costs per member plummet, and their operations teams get local economies of scale in maintenance, logistics, everything.
And once that fortress is built?
It effectively becomes a local monopoly. It's just too expensive and too slow for a competitor to come in and try to match that density, that convenience, and that price point. It's a very strong moat.
And we see proof it works.
Yeah, proof is definitely in the pudding. The best unit economics in their entire system are in the oldest dentist markets. Think Amsterdam. Those mature clusters report EBITDA margins way over 50%. The strategy fundamentally works when executed properly.
And the potential market in Europe, the runway for this model, it's still huge, right? We're not near saturation.
Oh, not even close. We're talking deep penetration growth here.
Right.
Right now, only about 1 in 10 people in their main European markets even has a gym membership.
Wow, only 10%.
Yeah, compare that to the US, where gym penetration is closer to, what, 22%? Maybe even a bit higher now?
So the European market could potentially double, maybe even triple, just to catch up.
Easily. Just catching up to existing standards in other developed markets implies massive growth potential, and a lot of that will likely be driven by the affordability that Basic Fit brings to the table.
And they're not just finding new customers, they're taking market share too.
Absolutely. They're expanding into what is still a very inefficient market landscape. Europe has something like 40,000 gyms, super fragmented. Our sources reckon about 70% of those are, inefficiently run independent shops, often family-owned, the classic mom-and-pop setup.
So Basic Fit comes in with this highly systematized, modern, cheaper alternative.
And they just roll up the market. They target new customers and convert existing members from those subpar, often higher-cost local gyms. It's a powerful combination.
Okay, so if the model is so brilliant, the market opportunity is so large, now we have to tackle that historical frustration. Why on earth did the stock just sit there flat for 4 long years?
Yeah, this is where we have to face the, let's say, painful truth. Management, particularly the CEO, has got a reputation for being too optimistic. That's putting it mildly sometimes.
They missed targets.
Consistently missed targets. They had really poor execution after their big investor days in 2021 and again in 2023. And that just creates this profound crisis of confidence among investors, right? You just stop believing the forecasts.
And what was the core operational mistake? The sources seemed pretty clear on this.
It was simple, but kind of catastrophic in hindsight. They basically assumed that the gyms they opened during that really chaotic 2020-2022 period, let's call it the COVID cohort, would mature and perform just like the gyms opened before the pandemic, back in, say, 2016 to 2019.
Which were performing well.
Those pre-COVID cohorts had rock-solid unit economics. But the COVID cohort assumption, it was just a fatal error. They grew way too fast during a time of massive operational disruption.
I mean, you think about it, lockdowns, reopenings, constantly changing rules, needing staff to check vaccine passes.
Exactly. Temporary closures, weird regulations, a real shortage of good staff available to actually train and manage this flood of new locations properly. The inevitable result was just a poor member experience right from the start in many of those new gyms.
And that poor experience wasn't just anecdotal. It showed up in the data, like the Google reviews you mentioned.
Absolutely. The Google reviews tell the story perfectly. It's the customer speaking directly. The difference was stark.
So the newer gyms in Paris.
Open hastily during that period, we're seeing average Google review scores down around like 3.3 to 3.5 stars. Pretty bad. Meanwhile, you look at mature, well-run locations in Barcelona, they were averaging a healthy 4.2.
That gap, 3.5 versus 4.2, that's not trivial.
No, it signals a real systemic failure in delivering the basic promise, and that leads directly to higher churn, people leaving faster, and reduced member length of stay. Those are absolute killers for the unit economics in a subscription business.
Okay, but the key point now is that they seem to be fixing this, right? The company isn't ignoring it.
No, definitely not. This is where the turnaround story begins. They've made improving that member experience, getting those basics right, a top operational priority, and it goes right down to the instructions given to shift managers on the ground.
Like what?
Like the new approach is very systematic. They're now literally telling shift managers to aim for getting, say, 2 positive Google reviews per shift. They're incentivizing the local staff to actively engage with members, make sure the place is clean, equipment's working, ensure quality.
That sounds like a real cultural shift, from just opening doors fast to actually focusing on the experience inside.
It is. And the proof seems to be coming through in the results from the more recent cohorts, the gyms opened in 2023, 2024, and what we're seeing for 2025 openings.
They're performing better.
Yeah, the evidence suggests they are finally performing much more like those strong pre-COVID cohorts. The operational fixes seem to be working.
Can we quantify that recovery? You mentioned the Google ratings improving overall.
We can. Management has reported that the average Google rating across the whole business climbed back up to 4.3 in the first 9 months of 2025. That's a significant jump from the low point, which was around 3.9 during the worst of that operational fallout.
Okay, 4.3 is much healthier.
Much healthier. It confirms that the focus on better staffing, better maintenance, just a better overall experience, it's working. It's rapidly stabilizing the business at the club level.
And that operational stability, that's the foundation for the financial leverage, right? Because ultimately, for a fixed cost business like a gym, it's all about getting more members through the door, members per store.
That is absolutely the metric that matters most. Once you've spent that $1.3 million or so to build the gym, the cost of adding one more member is practically zero.
All that extra revenue just drops to the bottom line.
Pretty much straight to the operating line.
Yeah.
And the recent results show this leverage kicking in really strongly.
Right. We saw memberships jump 13% year over year, hitting 4.73 million. But crucially, the number of clubs only grew by 5%.
Exactly. They're massively increasing the density within their existing footprint, filling up the gyms they already have.
That's pure efficiency gain.
And it's accelerating. The average number of members per mature club, that's clubs open more than 24 months, it jumped by over 100 members in just one quarter. Went from 3,074 to 3,176. That is really fast maturation.
Wow, over 100 members per club in 3 months. So if a mature club is targeting, say, 460,000 euro in EBITDA, how close does that 3,176 number get them?
They're closing the gap really quickly. To hit those target economics, they probably need about, let's say, another 200 members per mature club on average. So adding over 100 in a single quarter is huge progress. They're essentially pulling forward months, maybe even quarters, of future earnings maturation.
And that's critical because a lot of their clubs are already mature, right?
Yeah, about 74% are already considered mature. So the remaining 26%, the immature ones, they are highly leveraged to this rapid filling process. This is basically locked-in future profit growth that doesn't require spending any new capital. It's already baked in.
Okay, this feels like a good point to pivot to the core of the bullish argument, but also maybe the biggest point of debate. The unit economics themselves, the math of the box.
Right, the box economics.
Yeah.
And it is a compelling model on paper. Average build-out, as we said, roughly 1.3 million. The company targets a very healthy 30% return on invested capital, ROIC.
30% ROI.
Yeah. And at full scale, which usually takes about 30 months, maybe a bit less now, that gym should be generating somewhere between 400,000 euros and 450,000 in, let's call it, box-level EBITDA before you account for maintenance spending. So, strong cash flow per unit.
And when you filter that 30% ROIC target through the whole system, what does it mean for actual shareholder returns over time?
Well, after you account for corporate overhead, taxes, and importantly, maintenance Capex, which we need to talk about, that unit generates something like 210,000 euro of after-tax free cash flow per year.
So that's like a 16% yearly after-tax return on the initial 1.3 million investment.
Roughly, yes. A 16% after-tax cash return year after year. And that's before any potential price increases or getting even more members in. Plus, the new gyms break even really fast, usually within about 7 months.
Which lets them fund the next gym quickly.
Exactly. It's a self-funding growth model when it works properly. Aggressive expansion becomes possible because the units generate cash so quickly.
Okay, but now we have to hit the big bear argument head on. The maintenance capital expenditure. or maintenance capex. Bears argue the company is lowballing this number, making the returns look better than they really are.
This is definitely the number one point of contention if you're debating BFIT. Management estimates they only need about 50,000 euros to 60,000 euro per gym per year for maintenance capex to keep things running smoothly.
And the bears say,
The Bears jump all over that. They say, hang on, you spent 1.3 million building it, 60K a year. That implies the whole thing lasts over 20, maybe 25 years. And they argue for a gym full of treadmills getting pounded every day, weights being dropped, sweaty equipment, 25 years sounds ridiculously long.
right, they'd argue the equipment needs replacing much faster, so they think the true maintenance number should be what, closer to 130,000, 150,000 a year?
Yeah, something in that range, which would align more with maybe a 10-year lifespan for the bulk of the investment. And if you do use that much higher maintenance capex number, well, then the cash flow after maintenance shrinks significantly, and that attractive 16% after-tax return starts looking much, much thinner.
So, is the bull case dead if the bears are right about maintenance?
Not necessarily,
Yeah.
but it definitely hinges on understanding what's in that 1.3 million build-out cost. The bull rebuttal, and I think it's pretty strong, is that the initial capex isn't just treadmills and dumbbells.
What else is there?
A huge chunk of that cost, probably the majority, goes into long-lived structural assets. Think about the HVAC systems, heating, ventilation, air conditioning that's expensive and lasts a long time, the electrical wiring for the whole building, the extensive plumbing and drainage needed for dozens of showers and toilets,
Flooring, internal walls.
specialized flooring, internal walls, ceilings, lighting, all that stuff absolutely has a useful economic life way beyond 10 years, probably closer to 20 or 25 years, easily.
Okay, so the argument is, yes, you replace the treadmills every, say, 5 to 7 years, but the expensive HVAC system lasts 25 years. So the blended maintenance need is much lower than if you just focused on the short life equipment.
Precisely. It's a blended average. And industry folks, people who actually specialize in building out gyms, they tend to confirm this. When you look at the whole package, including all those tenant improvements or real estate improvements, management's lower maintenance capex number starts to look perfectly reasonable. The bears often seem to be fixating only on the lifespan of the equipment, maybe ignoring the significant chunk of the investment that's basically part of the building infrastructure.
That makes sense. Okay, now let's tackle what might be the real reason the market has potentially mispriced this: the accounting complexity. Specifically, this massive and actually favorable difference between the cash flow the business generates and the earnings it reports.
Yes. This is so important, especially if you're listening and don't normally track companies using international accounting rules, IFRS. Basic Fit's reported profit gets calculated using these complex IFRS standards, and they mandate several big non-cash charges. These charges dramatically understate the actual cash the company is generating and can spend or reinvest.
But that understatement is actually good for the company.
In a way, yes, because Basic Fit pays corporate income tax based on those lower reported earnings. So they end up paying less tax than they would if earnings equaled cash flow. This lets them compound more cash internally, tax efficiently. It's an accounting quirk that works in their favor, even if it confuses the market.
Okay, let's break down the three main non-cash charges that are hiding the true cash flow. First up, depreciation and amortization, D&A.
Right. As we kind of just touched on with the maintenance debate, the gyms are currently being written off on the accounting books too quickly. They often use a depreciation schedule tied to the typical length of their building leases, maybe around 10 years.
But we just established the actual useful life of many assets is much longer.
Exactly. So this accelerated depreciation on paper artificially reduces their reported profit compared to the cash coming in. Just this one D&A charge alone across the whole company probably underreports profit versus real spendable cash by something like $120 million a year. They're essentially taking a bigger hit on paper now than the actual wear and tear justify.
Okay, 120 million is a big number. What's the second one? This IFRS 16 lease accounting. Can you explain that simply?
Okay, I'll try. Imagine before IFRS 16, Basic Fit rents a building for 10 years, pays, say, $10,000 a month in rent. That $10,000 was just a simple operating expense on the income statement. Easy.
Made sense.
IFRS 16 flipped that on its head. Now, accountants have to look at that entire stream of future legally committed rent payments, maybe $1.2 million over the 10 years in our example, and treat it as if it's a giant debt liability sitting on the balance sheet today.
Even though it's just future rent they haven't paid yet.
Correct. And then the really weird part, they calculate a non-cash interest expense on this made-up lease liability. This accounting fiction, this non-cash interest, reduces reported profit by about $20 million a year for Basic Fit, even though all they're actually doing is paying their normal monthly rent. It makes them look more indebted and less profitable than they really are, cash-wise.
Wow, okay, so that's another 20 million understatement. And the third one was smaller, IFRS 9 for convertible bonds.
Yes, similar concept. Another accounting rule related to their convertible bonds that creates about another $10 million in non-cash interest charges hitting the P&L.
So add it all up. D&A, lease interest, bond interest. These accounting rules are making reported earnings significantly lower than the actual cash being generated.
Massively lower. The sources suggest the real underlying free cash flow generation is probably about €2 per share higher than the reported profit number that many people focus on.
€2 per share difference. That's huge for a 25 stock.
It's enormous. And think about the interest expense line. The IFRS rules force them to report a total interest cost of maybe $110 million. But the actual physical cash they pay out to their lenders and bondholders is only around $35 million.
So that 75 million difference is just accounting fog.
Pretty much.
Yeah.
Accounting fog that obscures a really powerful cash generation engine.
Okay, so what does this mean for how we should think about their debt and balance sheet risk? If we mentally strip out those IFRS 16 lease liabilities, which are basically just future rent payments, how leveraged is the core business?
Well, if you make that adjustment, which many analysts argue you should to see the true economic picture, the business actually looks incredibly healthy and quite capital light. Their net debt relative to their adjusted EBITDA, again, excluding the IFRS 16 noise, is projected to fall below 2.0x by 2026.
Below 2.0x net debt to adjusted EBITDA, that's very comfortable.
Very comfortable. And it completely contradicts the first impression you get if you just glance at their balance sheet, which looks loaded with debt. But most of that debt is actually future rent treated as debt under IFRS 16.
Okay, this really does sound like a setup for a potential re-rating. Let's pivot now to the specific catalysts. What things could actually force the market to wake up and recognize this hidden value? The first one seems pretty straightforward. Maturation of existing gyms.
Yeah, maturation is almost like guaranteed passive earnings growth at this point. Because right now, a really big chunk of their gym network, maybe 30% to 40% of their clubs, that's over 500 locations, are still technically immature.
Meaning less than, what, 2.5 years old?
Exactly. Less than about 24 to 30 months old. So they have all the fixed costs of a fully operational gym, the rent, the staff, the basic utilities, but they haven't yet filled up with the target number of members. They're still ramping up.
So just by sitting back and letting these existing 500-plus gyms naturally fill up over the next couple of years, what kind of financial impact are we talking, even if they stopped opening any new gyms today?
The analysis suggests that just the maturation of this existing cohort of immature clubs is poised to deliver potentially an extra $150 million in EBITDA flow-through.
Wow, 150 million more EBITDA just from gyms they've already built.
Yes, purely from existing Capex coming online fully. That passive growth alone is expected to push the overall company operating margin up towards 20%. It's like a giant slug of future earnings growth that's already locked in, just waiting to mature.
Okay, catalyst number one, guaranteed maturation. Catalyst number two sounds a bit riskier, but maybe has even bigger upside. This French 24/7 investment.
Yeah, this one's fascinating. It involves a significant strategic investment they're making this year, in 2025, about $35 million specifically to enable 247 operations in around 330 of their gyms in France.
And that 35 million cost is because of a specific French law?
Exactly. Unlike most other European countries where they operate, current French labor law requires that staff must be physically present whenever a gym is open to the public. So, to offer 247 access in France, Basic Fit has to pay for overnight staffing.
Which is expensive, presumably.
Very expensive,
Yeah.
especially since they're apparently using flexible contract labor for a lot of it, which costs more per hour, but gives them flexibility. That $35 million is mostly extra staffing costs.
Okay, so that's the cost. But the potential upside, if they can somehow get around that law,
Is massive. It's a double upside, really. First, management is actively lobbying the French government right now to change the law and allow staffless operations overnight, like in other countries, if they succeed.
they could save most of that 35 million.
They could potentially eliminate about $30 million of that recurring annual staffing cost almost overnight. That's why they're using contractors that can get rid of them quickly if the law changes, avoiding the notoriously high costs of laying off permanent employees in France. It's a smart hedge.
Okay, that's huge potential cost savings. But what about the revenue side? Does offering 24/7 access itself actually drive enough new members to justify the 35 million cost, even if the law doesn't change?
It seems like it absolutely does, and the internal estimates might even be conservative. Basic fit management often guides quite cautiously on growth from new initiatives. But there was a comment from their Spanish country manager noting that when they converted their Spanish gyms to 247, they saw something like a 30% increase in the average number of members per gym.
30%. Wow, that's way more than needed to cover the staffing costs.
Way more. And Basic Fit Management seems confident too. They've publicly stated they expect the 35 million annual cost to be fully offset by the extra membership growth generated by 2047 access by the end of 2025, even if the French government doesn't change the staffing rule immediately. So worst case, it pays for itself through growth. Best case, they get the growth and save 30 million in costs.
That's the blue law analogy we talked about before preparing for this, isn't it? Like when stores used to have to close on Sundays. It's a single regulatory change that, if it flips, gives a massive, maybe permanent cost advantage to the player who is already set up to benefit.
Precisely. If Basic Fit gets that French staffing law changed, that structural cost advantage would massively solidify their local monopoly across their, what could be 600 to 800 locations in France eventually. It would be almost impossible for smaller independent gyms to compete on price if Basic Fit can run staffless overnight, and they can't.
Okay, so Maturation and France 24/7 are big potential drivers. We're also seeing positive signs on the revenue side from improving the member mix, right? Getting people to stay longer and pay more.
Definitely. The service improvements are leading to higher stickiness. The average length of stay for a member has climbed up to around 24 or 25 months now.
That's really good for a gym, isn't it? Usually churn is high.
It's excellent. More than double the traditional 12 months you might see at a standard European gym. That higher retention drastically cuts down on churn and the cost of constantly acquiring new members to replace leavers.
And people are opting for the more expensive membership tiers, too.
Yes, that trend is strong. In the last reported quarter, 40% of all new members chose their higher margin ultimate plan. 40%.
What's driving that? Are they adding new perks?
They are. Basic Fit is constantly testing new amenities and features to make those premium tiers more attractive. Things like specialized strength circuit training areas, dedicated relax and recover zones, maybe chair massages, or even cryo lounges in some test markets like Benelux.
So they're trying to upsell.
Trying to upsell, but also showing they can be responsive to local demands. Like the example of them adding more leg machines in Spain because apparently people wear shorts more often due to the warmer weather and focus more on leg workouts. Little things like that show they're optimizing the offering.
So better service, higher retention, more premium members. It all feeds into higher revenue per member and margin expansion.
Exactly. Better yield from the existing members, combined with that operational leverage and cost control, should guarantee operating margin expansion over the next few years.
Okay, let's talk about the leadership for a minute. Rene Moose, the CEO, he's the founder, still owns a big chunk, about 14% of the company, so his interests seem aligned. But we can't just gloss over the past criticism that he was too optimistic and presided over those missed targets.
No, you can't gloss over it. The criticism about the forecasting accuracy was entirely fair, and it's a big reason the stock languished for so long. Investors lost trust. However,
There's a but.
there's a big but. Our sources really emphasize that you cannot easily replace specialist management in this specific sector. Running a hyperscaled, low-cost gym system efficiently across 5 or 6 major, distinct European countries requires incredibly specific, deep operational knowledge.
It's not a generic CEO job.
Not at all. These kinds of operational specialists, people who know the nitty-gritty of running hundreds of gyms this way, they are not a dime a dozen, as one source put it.
And there are cautionary tales out there, right? Other fitness chains where maybe more financially oriented or generic management came in.
Yeah, look at what happened at some other chains, maybe like Exponential Fitness was mentioned. When non-specialist management took over, sometimes the focus shifts away from the core operational details, and the quality of the actual gym experience can deteriorate pretty quickly. And that ultimately hurts the brand and the economics.
So the argument is keep Moose and his core team, despite past forecasting errors, because their operational expertise is crucial for actually executing the cluster strategy and maintaining those unit economics.
That's the consensus view now, I think. The market seems to have shifted its focus. Instead of just punishing the past optimism, it's starting to reward the current, much more disciplined execution that the team is delivering. Retaining that founder-operator, who really understands the gym floor dynamics, is seen as vital for repeatable success going forward.
Makes sense. Okay, what about capital allocation? Now that the business is stabilizing, cash flow is picking up, what's the plan for that cash? Just build more gyms as fast as possible again.
No, they definitely seem to have learned from the past mistakes of growing too quickly. The strategy now is much more disciplined growth. They're aiming to open at least 100 new corporate-owned gyms per year. That's still strong growth, but it's described as a measured pace.
Measured to avoid overwhelming their operational capacity.
Exactly. A pace that ensures they don't repeat the quality control problems of the COVID cohort. They need to be able to properly staff, train, and maintain the quality standards in every new gym they open. So steady, high-return new openings.
And what about the cash flow that's left over after funding those 100-plus new gyms?
Share buybacks. That seems to be the clear priority for excess cash. With the stock trading around, say, €25 today, both management and the analysts covering them view any price under €30 as basically a no-brainer for buybacks.
So they see their own stock as significantly undervalued.
Clearly. And given the strong underlying free cash flow we discussed, which the market maybe isn't fully recognizing yet, they're well positioned to use that excess cash to systematically reduce the number of shares outstanding, which, of course, amplifies the earnings per share growth to the remaining shareholders down the line.
We should probably touch on franchising, too. Is that becoming a bigger part of the strategy? Are they planning to sell off existing gyms to franchisees?
No, not really. Franchising seems to be viewed more as a secondary opportunity, kind of like a cherry on top. It's not about refranchising their successful corporate-owned gyms in core markets like France or Spain.
So what's the role of franchising then?
It's more seen as a way to potentially leverage their brand, their scale, and their operating systems to enter entirely new geographies. Maybe places like Austria, Italy, Poland were mentioned, but using external capital from franchisees. It could add maybe 5%, perhaps 10% to the future value of the business, but it doesn't seem to distract from their main focus, which is executing that high-return, corporate-owned cluster strategy in their established markets.
Okay, got it. Core is corporate. Franchising is for new market entry, potentially. All right, let's get to the bottom line, the valuation argument. If we accept the premise that the cash flow is much stronger than reported earnings suggest, just how cheap is this stock potentially trading right now?
Well, if you make those adjustments for the non-cash accounting charges we talked about, the argument is that the stock is currently trading at roughly 5 to 6 times its expected 2027 free cash flow.
5 to 6 times 2027 free cash flow. That sounds really low for a growing European consumer business.
It is really low. Let's put it in context. A comparable high-quality fitness operator like Planet Fitness in the U.S., their corporate stores, and the value ascribed to their franchise system often trade at multiples closer to maybe 9 or 10 times EBITDA. And that usually translates to a price-to-free cash flow multiple somewhere in the mid-teens, maybe around 15x.
Okay, so if Basic Fit is executing well, has strong unit economics, and is growing, that gap between 5-6x FCF and maybe a pure multiple of 15x FCF is just enormous potential upside.
It suggests massive potential for multiple expansion as the market gains confidence in the cash flow story. And if you run conservative discounted cash flow models, DCF models, based on metrics that strip out the accounting noise, like EBITDA minus actual rent paid,
What kind of fair value does that suggest?
the more conservative models seem to land around $50 per share. And that's really just applying a more sensible industry average type multiple to the cash flow that we can see is likely coming just from the maturation of the existing gyms. It doesn't even require heroic assumptions about future growth.
€50 compared to 25 today. That's a double.
Yeah.
But we also saw some much higher price targets mentioned in the sources, right? Like 60, even €90 per share. How do they justify numbers that high?
Those more aggressive targets are really based on the long-term compounding power of the model. If Basic Fit manages to hit their internal goal of generating around €6 per share in free cash flow by 2030 at the latest.
Which seems plausible if maturation completes and maybe that French catalyst hits.
Exactly. If they hit that 6 FCF per share number, and if the market finally decides to award it a peer multiple, like that 15x we mentioned, well, 6 times 15 is 90 years, so mathematically you can get there. The core argument is simply that the stock has arguably never been cheaper relative to its visible 5-year forward free cash flow potential.
There was one other valuation angle that was interesting, comparing the company's total value, its enterprise value, to the cost of just replacing all its existing gyms.
Right, the replacement cost argument. The company's total enterprise value, EV, that's market cap plus net debt, is around $2.6 billion right now. We know they have roughly 1,600 clubs, and we said the average build-out cost is about $1.3 million each.
So 1,600 times 1.3 million, that's about 2.1 billion just to physically rebuild all the gyms they currently operate.
Exactly. The physical replacement cost of just the assets is around $2.1 billion.
Okay, but the market cap, the value of the shares, is only 1.6 billion.
Right. So think about what that implies. The market is currently valuing the entire ongoing business, the Basic Fit brand, all the operational know-how, the established customer base of 4.7 million recurring members, the prime real estate locations they control in major European cities, at only about 500 million above the bare cost of replacing the physical assets.
That sounds crazy cheap. Like you're getting the entire brand and customer base for a tiny premium over the bricks and mortar and treadmills.
It implies the market is pricing the whole operational platform at almost a below replacement level. Once you factor in the huge intangible value of the brand, the established clusters, the recurring revenue stream, it really suggests that consensus has just been far too conservative, too focused on past issues, and hasn't yet priced in the operational turnaround and the maturation benefits that are already starting to show up in the numbers.
The market seems to be slowly transitioning from punishing the old mistakes to recognizing the current strength and future potential.
That feels like exactly what's happening.
Okay, so let's try and bring this whole deep dive together then. The core story seems to be Basic Fit is fundamentally a really strong, low-cost, high-return growth machine.
Yep, that's the engine.
The stock price lagged for years mainly because of two big but probably non-recurring factors. First, that really complex accounting, the IFRS stuff, that created a fog around the true cash flow.
Hiding the real profitability.
And second, those operational stumbles related to the rushed, lower quality gyms opened during the COVID chaos.
The COVID cohort problem, yeah.
But now the underlying unit economics look proven, they're robust, and crucially, they seem to be stabilizing rapidly as management focuses on quality.
The operational fixes are working, the numbers show it.
So the business looks set up for a potentially significant re-rating, driven by, three main things. First, that locked-in growth from hundreds of existing gyms just naturally maturing over the next year or two.
Passive earnings growth, already paid for.
Second, the accelerating member growth per store, showing strong demand and increasing density.
Filling up the boxes, driving leverage.
And third, that big, maybe more speculative, but potentially game-changing regulatory catalyst in France with the 247 staffing rules.
Huge optionality there, both cost and revenue side.
So the path forward looks pretty clear. As those strong, real cash flows become more visible, as the maturation hits the bottom line, the market should theoretically be forced to apply a higher multiple, which triggers those twin engines we talked about at the start.
Cash flow growth and multiple expansion. That's the potent combination investors are looking for.
It really feels like the market might be slowly waking up to the fact that it dramatically misread the stability and the compounding power of this low-cost European giant.
I think it's a fair assessment. The narrative is definitely shifting.
Okay, so to leave our listeners with a final provocative thought to mull over, we spent a bit of time talking about how gym usage in Europe is still really low compared to the US, but also how Basic Fit's affordable model seems to naturally increase that penetration rate whenever they enter a new city or region.
Yeah, they make fitness accessible to more people.
Now, think about the bigger picture, the macro environment. Governments all across Europe and their health insurance systems are grappling with absolutely spiraling healthcare costs, especially related to lifestyle diseases, obesity, lack of activity.
A massive societal problem.
So what if those governments, or maybe the big insurance companies, start getting serious about preventative health? What if they begin providing real incentives, maybe direct subsidies for gym memberships, or perhaps reducing the VAT tax rate specifically for high-volume, low-cost fitness providers like Basic Fit?
Interesting, like making gym access part of the public health infrastructure.
Exactly. If that were to happen, Basic Fit's dominant low-cost model could transition from being just, a consumer discretionary service that people choose to buy
to becoming potentially a critical, maybe even subsidized piece of the national health infrastructure in several countries.
Imagine the acceleration in adoption if gym memberships became significantly cheaper or even partially covered by health plans. It could massively expand their addressable market, not just fitness buffs, but the broader population.
That would be a fundamental shift, locking in their role across the continent and turbocharging growth. A very powerful thought.
Something to think about. Thanks for joining us for the deep dive.